How's everybody doing this morning? Great. Come on. How's everybody doing this morning? That's what I'm talking about. All right. My name is Dan Passarelli, and I'm really excited to be here. You guys excited to be here? Yeah. All right. Where's everybody from? We're going to take no more than 60 seconds, and each person's going to tell us where they're from. I'm just kidding. My name is Dan Passarelli, and I'm honored to be your first speaker here today for the All-Stars of Options. I am the president and founder of Market Taker Mentoring, the leading options education company in the U.S. and some would say world. I am here today to talk about a revolutionary approach to covered calls. Now, how many of you currently use options in your investing? Nice. All right, great. And of you, how many people use covered calls as a pretty big part of that? Great, all right, excellent. All right, before we get started, I need to point out options are not for everyone, and you should read characteristics and risks of standardized options before trading. You can get a copy of that by calling 1-888-OPTIONS. So let me just give you a tiny little bit about my background before we get going so you know who's talking to you. Before I founded Market Taker Mentoring 10 years ago, this is our 10th anniversary, helping investors like you, I was a market maker down on the floor of the Chicago Board Options Exchange. Did that for a number of years. Still to this day, use options every day in my investing and trading. I'm the author of the books Trading Option Greeks and The Market Taker's Edge. I think maybe there's a bookstore here today. If there is, stop by. And let's see here. Whoops. How come this is not working here? And, well, now what I do with my time is help investors just like you. Okay. How many people have ever been in a situation like this? Covered calls are rather interesting strategies. There are countless white papers written on covered calls that say two things, two really, really important things. One is that covered calls will outperform the buy and hold strategy in the long run. It's pretty powerful, right? The other thing those white papers will tell you is that they do that while lowering risk. Now, what are your two jobs as an investor / trader? What are your two jobs? Anybody? Make money. Control your risk. Protect the nest egg, right? If you give me any other jobs, I think they're probably subsets of those two things. Which comes first? I don't know. Doesn't really matter. It's kind of more a psychology question to the person I'm asking that question to. Those are both really important. Covered calls are designed to do exactly that. Both outperform while lowering risk. Now, people tell you, and rightfully so, if I want more reward, I have to take more what? Risk. So that, in some ways, is a little bit contrary to what I just said here, right? More reward, less risk. But see, this is the nature of being a trader. It's not really just going there and getting into a trade and trying to make some money and trying to control the risk. I mean, that's sort of the big picture. But what really makes this work is to look for very, very specific criteria. And when you have that very, very specific criteria and put it within a system, what that does for you is it kind of massages that risk-reward relationship. It sort of optimizes. You're always looking for, not really a needle in a haystack, because good trades are much easier to find than that, but you're looking for sort of the outliers. You're looking for the things that specifically put you at an advantage. So that's what covered calls can do. So they're great, right? but they have their problems. How many people, now it looks like maybe 2/3 of the room have some experience with covered calls, maybe half the room. How many of you who have used covered calls, you're fairly familiar with what we're talking about, have owned a stock, you had a covered call on it, and the stock that you own is rising, and you're sitting there going, oh man, I wish the stock would stop going up. How many people? Tell the truth, how many people? Yeah. So, it's very common. At Market Taker, we've put over 3,500 people through our classes. And we do a lot of one-on-one coaching work. We talk to a lot of traders one-on-one in intimate settings online where they tell us their deepest, darkest fears and problems. And this is one of them. But it doesn't really make any sense, does it? So we kind of have to have a way to change that mindset. All good trading is about mindset. In fact, mindset is one of the things that we actually do a lot of work with, abilities, which of course is why you're all here today, right? But then when we narrow down a little bit, the mindset really has to do with what our objectives are. Now, there are a lot of traders that we work with who they hear that covered calls are great, and they trade them, and it doesn't work for them. They end up using the strategy that's actually been proven. This is not an opinion. I mean, I'm citing like white papers written by independent, respectable third parties, proven to outperform while lowering risk. But when they use them, it doesn't work. I mean, they do okay, but they get to the end of the year and they say, the S&P 500 is up, 12% this year, and I'm up 9%. I thought I was doing good. So the key, one of the biggest reasons for failure is objectives, not setting objectives. Now, you may be surprised by some of the objectives, and that's sort of where the concept of a revolutionary approach to covered calls comes from. How many people have ever heard that covered calls provide limited insurance? Okay. Now remember, how many people have never heard that covered calls provide limited insurance? Okay. I just want to point out that being an option trader, I'm from Chicago, and everybody has to vote at least once. All right? Get it out of the way. So a lot of times people will cite this, let's not say fact just yet. They'll cite this quote. They'll say, when I own a stock and I sell a call, and by the way, there's about half the room who have never used covered calls. We're going to get into a kind of crash course in a second. But I want you to sort of understand these things before you even get into that. A covered call is when I own a stock and then I sell a call short. And the benefit of that is that I take in the premium. That's why we call it generating income. And so the way a lot of people think about it, and what a lot of people say about it, is that that premium that I take in provides limited downside protection, limited insurance. And it's sort of the opposite of a real insurance policy. Like, if you have insurance on your car, and you have a small little fender bender, and it's $500 to get fixed. Who pays for that first $500? You do. It's called what's it called? It's called a deductible. You take on that limited amount of risk yourself because it's limited, who cares? When you crash your car, and it's totaled, and it's $10,000 worth of damage, you still pay that limited amount, but then the insurance company picks up the important part. So with covered calls, yeah, I own a stock at, $100, and I collected a $2.50 limited insurance policy. So basically, they're giving me the deductible, but I've got all the risk, right? So that's sort of one of the fallacies about this limited insurance concept. How many people have ever kind of rationalized that? How many people have thought about it that way? Yeah. And so early on, I thought about it that way as well. And I thought, that's ridiculous. This is not an insurance policy. This doesn't really protect me. I don't need protection for normal market fluctuations. I need protection if I want protection. So is that really an objective? Is that really a motivation? No, not on any one individual covered call trade. And that's sort of part of the magic of this approach, this system that we teach called the MTM Smart Income System. It's that with any one covered call, getting that tiny little cushion, enough to cover my deductible while I've got all the downside risk, that's not insurance. But when it's part of a system, when I roll and I collect a premium this month, or this 2-week period with weeklies, and then when we get around to expiration, I do it again and I take in more, and I do it again and I take in more, and I do it again and I take in more. Over time, this actually becomes real insurance. Covered calls only work when they are part of a system. If you make one covered call trade in your life, great. It may have worked out for you. You might have left money on the table if it went too high. You might have lost money if it went too low, the stock. One covered call trade is not beneficial. Any one individual covered call trade is not really beneficial. But many, as part of a system where I have a process, I have certain criteria that must be met. I have certain steps that I follow to identify the trades, to analyze those trades, to select the best strikes and expirations, and extremely importantly, to manage those trades. Now covered calls become very, very powerful. Because the fact is, and this kind of turns a lot of what seems on the surface logical about covered calls, it kind of turns it on its head just a little bit. Covered calls actually are great for down markets. It doesn't seem like that when you're looking at the regular old P&L diagram that I'm going to show you in a second. It seems like, oh no, there's where all the risk is. And at any moment in time, that's true. But over time, it's really not. Over time, we're erasing that risk incrementally over and over and over again. The upside exposure is really where the potential problems can lie. That, oh no, the stock that I own is going up. Oh no, what am I going to do? That's where the real problems lie with covered calls. Unless, of course, you have that system. Unless, of course, you can do managing and adjusting so that you don't get assigned and get the stock called away. You're out of the problem before then, and you're keeping your gains on the stock and reversing any losses on the call. So as part of a system, like covered calls can be just a revolutionary change to what you've been doing. All right, so I realize that there's many people here who are not very familiar with covered calls, so let's have a little bit of a crash course here. A covered call is when I own a stock and then I sell a call short. So it's not that I already own the call and when I sell it, I open a short position. Now, I say own the stock. How many people have ever bought a stock and sold a call all at once as one single trade? Mm-hmm. So that is a type of covered call. That's called, what is that called? A buy rate, exactly. Now, those are okay. it again depends on your objectives. If my objective is to make some quick money on this because I think the call is going to expire and I'm holding all of this downside risk for this short period of time, it may not be the best option. Pun somewhat intended. For traders, we do other things like maybe debit spreads. This is an investor-oriented strategy. So a lot of the context of the MTM Smart Income System is talking about this, doing covered calls on stocks that I already own. This is generally considered to be a conservative investor strategy, and I've got a couple of objectives for doing this. One is I want to generate income on low volatility stocks or ETFs. Two, I want to lower my cost basis, now not tax cost basis, but this cost basis that I've been talking about where I slowly erode my effective purchase price on the stock. Three, to potentially set an exit for a stock or an ETF. Now I will tell you, bullet point 3 is a very underused methodology of covered calls. The MTM Smart Income System actually uses bullet point 3 here, the last one on the screen, to potentially set an exit strategy for a stock or ETF is a very big part of our system. Now that doesn't mean, okay, I'm going to sell, if I get assigned, I'm just going to hold it till expiration, I'm going to sell the stock and I'm out and move on, and oh great, I left money on the table. No. It involves maybe doing things like writing puts. I mean, there's a little bit to it, but if I get assigned, I write a put, or even if I want to get assigned and sell the stock, I might still buy it back prior to expiration, roll to a different strike, take in more premium, make it even better. So the way to think about a covered call, what I would say is the right way, is I look at the stock component as my long-term investment. And I look at the call component as a temporary augmentation, adding value to something I would otherwise be doing anyway. And that's really key to understand it that way. I'm not putting on a covered call because, oh, this covered call is I like the profit and loss diagram that we'll look at. I'm putting it on because I already like this stock. I'm not going to sell this stock. Maybe if it goes down, I'll buy more. Maybe if it goes up, I wouldn't expect it to go much higher, so maybe I'd be okay selling it. But it's already part of my plan, but I want to make that plan better, right? This is what it's like in any business, any, sport team or anything. You come up with a plan, and you get it working, and then you make it better. That's exactly what we're doing here. And so there are very, very specific actions that need to happen in order for the plan to actually become better. This is not, there are so many times when I work with investors, me or John. John's our head coach. He's in the back of the room. Say hi, John. All right. There's so many times when John and I work with investors and we talk about covered calls, and a lot of times these are individuals who've been investing for a long, long time, and they're great at picking stocks. But then they hear that covered calls are great, they read some of these white papers, and they say, oh, that's fantastic. And what do? They just find some call and sell it. They don't really think about the objective of it. They just heard it's good, so they do it. They don't really think about, well, what's the criteria I need here? Like what makes this a good covered call, specifically in this specific situation? A big problem is they don't think about the price versus value of a covered call. How many people, this Traders Expo, so I think there's probably a lot of traders here, but how many people also, investing is sort of a big part of what you do. I make an important distinction between investing and trading. Right, a lot of you. So of those of you, how many take a sort of value approach? Like you think of what the value of a stock is versus what the price of the stock is, and that's how you make your investing decisions. How many of you do that? It's fairly common among investors, isn't it? Right. A lot of investors do that. Most investors do that. But a lot of times when people use covered calls, they say, well, I'm going to sell a call because I heard it's good. And they say, oh, well, the call's 85-cent bid, so I'll sell it at 85 cents, and there's my covered call. Is that 85 cents a good value trade? Am I selling something that's overpriced and gives me a decided advantage in the long run? Am I selling something that's underpriced and putting myself at a disadvantage and actually kind of doing something that will work against me in the long run if I continue doing it that way? So there are very, very specific actions and very, very specific setup requirements. So this is what a covered call looks like. I own a stock. Maybe I bought it today. Maybe I bought it last week. Maybe I bought it 20 years ago. Right now, it's trading at 130.28. So I may look at selling what we call an out of the money, so a higher strike call. In this case, it's about $15 out of the money. Sell the 145 strike calls at $1.31. Now, a couple things to note here. I own the stock, and I have the risk of the stock falling. I have the benefit of the stock rising. And then I sell the call, and the call introduces a whole new sort of thing for me. It introduces these really key trade-offs that must be understood. One is, the thing that gets us excited about this, is that I'm taking in about an extra 1%. If this is a 2-week trade, if there's 2 weeks until the call expires, it's pretty fantastic. I can generate 1% in 2 weeks. If I do that every 2 weeks, that's 24% a year. Now, that's a little bit of an oversimplification. It's not going to play out that way exactly. But I want your minds to start thinking about it that way. I want to open your minds to the possibilities. So that's really the benefit. Generate this income. Make more on what I'm already doing. But I've got this trade-off, don't I? If the stock rises above my strike price, I might have to sell the stock at $145 and leave money on the table. If the stock falls too much, well, I own the stock, and if stocks fall that I own, I lose money. So let's examine this a little bit more closely here. Hypothetical example, I own 100 shares at 70. I'm going to sell one of the May 75 calls at $2. So what we do is we look at this as a possibility. Whenever we're looking for a covered call, we look at the setup as a possibility. And then we think about how it fits into what we call our overall plan fit. What does this do for us besides get us an extra, couple percent or something? What does it do for us? And then we do some screening. And we look at the criteria that we need, the covered call candidate criteria. And if it fits into our overall plan and it meets our criteria, then it's a go. Then it's a green light. And if it doesn't, then we pass and we look at maybe a different stock we own. Okay, so if I own 100 shares at 70 and I sell one of the December 75 strike calls at 2 and I hold this all the way until expiration, if that stock is trading above $75 a share, I make money. How much do I make? $7, right. How do I make $7? Well, because the stock was at 70, it rose to 75, there's $5, but I also get to keep that $2 option premium, so that's $7. If the stock is below the strike price at expiration, so maybe it falls, maybe it stays where it is, maybe it rises a little bit up to almost 75. If it's below the strike anywhere at expiration, then I'm actually doing okay. This is where that sort of limited insurance comes in. Not really limited insurance. Sort of a better way to think about it is I'm lowering my effective cost basis. Yeah, I own the stock at 70, but I sold this call at 2 and it expired. It's gone now, but I still have that $2. I'm in this thing at 78. And if I compare that to just simply owning the stock, basically what that means is if the stock is anywhere below the strike price at expiration, I always outperform the buy and hold strategy. So there's a couple of things that we're looking for here. I'm going to introduce a couple of the key candidates that are part of a long-term system. One of the things I want to look for is resistance to help set my strike. And there's a couple other specific chart setups, but resistance is one of the big ones, so I'll definitely give you that to go home with here today. And stocks with high amounts of cash and low debt. Now, that's the stock component. For the options, I'm looking for a couple of things here. I'm looking for overpriced options. Just like value investors only buy stocks where the price is below the value. For option traders who are selling options short, we only sell options where the price is above the value. Otherwise, it doesn't work in the long run. It's just sort of like, well, here's something I think we can all relate to, being here in Las Vegas, right? How do casinos make money? Are they in the gambling business? No. They're in the math business. They look at what the odds are, and they set their payout structure according to what the odds are, and they give themselves a small edge. If they didn't do that, they just said, I don't know, I think we feel pretty lucky tonight, and they just made everything a fair game, it's not going to work for them. If they put themselves at a disadvantage, well, you're at the disadvantage, right? The odds are somewhat against you. Doesn't mean you can't win on any one given night, but in the long run, you're supposed to lose. So that's what we do with the options. We look for overpriced options, and we see how it fits into a long-term plan. And we see if it meets the required covered call candidate criteria. So for this revolutionary approach that we have here, what brings you forward the most is to stop worrying about the wrong things when it comes to covered calls. Now, I will tell you, the MTM Smart Income System that I've worked on for, well, basically 2.5 decades, but very, very concentratedly the last year exclusively. It comes out of talking to thousands of traders at expos like this, our individual students, subscribers, and listening to what goes wrong with their trading and giving them a solution to fix it. Taking the stress and sort of the anti-mindset of owning a stock and wishing it doesn't go up. It just leads to making more and more bad decisions. We need you to not worry about that. We need you to have a solution in place to deal with that. We need to change your mindset from being too stressed out about the stock falling. With the volatility that we've been experiencing lately, now look, this is something that I practice what I preach. I'm constantly trading covered calls and cash secured puts in my retirement account. With this volatility that we've been experiencing, I love it, even when the market falls. Now, I'm generally speaking long the market by owning covered calls or by being short cash secured puts. I'm what we call positive delta. always. So when the market goes down, that hurts that delta. That hurts me. But guess what? It hurts me a whole ton less than most people. When the market falls and I roll to a new option, I'm locking in that delta loss. But I'm bringing in a big premium, especially when the market falls a lot. What happens to option prices when the market falls a lot? The option prices themselves go up, relatively speaking, both calls and puts. And usually, it goes up by too much. People panic. People buy these insurance policies. They buy this protection. They buy this upside exposure. They pay too much. And when the market falls a lot, they pay a lot too much, which gives us, everybody in this room, a great advantage if you can capitalize on it, including and especially in your retirement accounts. Because what you can do is we roll and we sell a nice fat premium that erases a good percentage of what we just lost. Whereas the people who are not doing this, they don't get that. They take the loss. And a lot of times what they do is they do the opposite. They're the people who are selling those options to. They buy puts at the bottom. But I'd like to thank them because they're the ones who drive up the prices for people like us, right? Okay, one more thing. Playing the expiration game. Now, this is another part of what I'm referring to as this revolutionary approach. When you see presentations on covered calls, including this one, to be fair, you see something that can, if not clarified, which is what I'm about to do right now, you see something that can cause you to do this wrong. You see this. This I put in my presentations, and I speculate that most people like me who teach covered calls put this in their presentations. We put these things in our presentations just to make it clear, to give you a base understanding of, here's sort of big picture what this is basically sort of all about. But in reality, you're pretty much never going to realize this. Because this is a P&L diagram, but I like to refer to these as at-expiration diagrams. This is only relevant at one exact moment in time. What moment in time is that? That's right, expiration. And the fact is that we're not going to be holding the call until expiration. At some point, when used as an exit strategy, we might allow that to play out. That becomes part of our plan at the very beginning. It's not a choice we make later, it's a choice we make at the beginning. But almost never, 80% of the time, we're not going to be holding these until expiration. Now, this is something that I've had a lot of conversations with people about. We were at a function a couple of weeks ago with a lot of investors. And I brought up this important point. Why do you hold options until expiration? Well, because I want to get the full value. I sold the call at 90 cents, and there's still a nickel in it. Why would I pay a nickel to get out of it? Because the nickel's $5 of money. And if there's another 10 days until expiration, you're waiting 10 days to get another $5. When you could just simply roll and maybe take in another 90 cents and instead make more. Now again, this is not necessarily always the case, but it's sort of what I refer to as the expiration game. When you get to the point of the risk-reward not really being worth it anymore, like waiting around to make a couple extra dollars when you could be making a lot, it's another part of this mindset. So we need to focus our attention on the right things. We need to focus on the covered call candidate criteria that get results, that enable us to select the top covered call candidates. We need to focus on a systematic approach so that when the stock goes up too much, that's fine. I've got a way to deal with that so I don't sell the stock, so I keep the profits on the stock, reverse the losses on the option. Excuse me. Now, I want to introduce the 8 Nail the Trade Candidate Criteria Checklist. This is the starting point for the MGM Smart Income System, but also for you being successful with this. This, again, is 25 years in the making. All right? We're going to look for stocks or ETFs already held that are non-volatile. We're going to look for stocks priced above $30 a share. We're going to look for overpriced volatility. We're going to avoid earnings. We're only going to trade when the spreads are liquid. We're going to manage the strike proximity to give ourselves maximum profit. We're also going to use what we call the make sense factor and also the overall plan fit. Now, the bottom line is you cannot make money unless you find great trades, right? Right? Now, good news and bad news is that's what everybody focuses on, because that gives you your greatest starting point. If you don't start with a trade that has a great opportunity for you, nothing else you can do after that matters. So this is sort of where it all begins. We need a tested set of criteria so that we're only trading the best candidates. We need a system to ensure success and attain consistency. Again, one covered call trade is not exciting. It's not all that beneficial. It's like if the casino one night a year let one person come in and make one bet. Then they're back to the gambling business. They don't have an edge. They don't have an advantage. But they maintain consistent profits over time because they're doing it over and over and over again. They've run the math. They've figured out how much to pay the pit bosses and the dealers and all that. It is methodology. So, there is actually, if you looked in your programs, there is a Traders Expo Masterclass, which I've been asked to be an instructor. It is a 4-hour workshop tomorrow from 1:30 to 5:30. Mark your calendars for that. The information is in your book. The presentation is called Experience the Power of the MTM Smart Income System. Now, I just kind of want to point out a couple of things here. Like, think about this, and really think about this as I'm saying this. Like, what is your reason for being here? There are some people who are here just to try it out. They heard covered calls are great, and okay, well, let's see what this is all about. And I'm glad that you came. And I hope that I gave you a solid understanding of what they are and what the possibilities are. And then there are the tchotchke hunters, and we see some of those. We've got really great pens. We just ordered some brand new pens. They write great, John. So you can come by and get some tchotchkes from us. We actually have a couple of koozies, too. And some people, it's early, it's Vegas, maybe you were out and you thought, well, you know, I kind of need a nap. I'm going to check out this class. It sounds boring. Hopefully that wasn't your motivation. But some people, and I think most people, because you're here at 9 o'clock in the morning in Las Vegas, you're motivated. You want to make this work. Who does that describe? Okay, you, and you. Great. Who does that describe? Okay, better. You want new skills so that you can be more profitable. And you're here for a reason. You're here to transcend your trading and investing. You made an investment of time, and you made an investment of money, to fly here, get a hotel. So I'd like to invite you guys to attend this class tomorrow from 1:30 to 5:30. It's called Experience the Power of the MTM Smart Income System. And we go over a couple really important things that kind of piggyback off what we talked about today. The covered call proposition. There are two basic principles that make or break a covered call trade every time. There's the 8 nail the trade candidate criteria. We didn't have a whole bunch of time to get into it in this 45-minute presentation because we had other stuff to cover. We've got 4 hours. We're diving deep into that, and we're diving really deep into the simple candidate identification formula, which is the first step of the MTM Smart Income System. And then we're basically laying out a complete, easy-to-follow system for making your investing simpler and more profitable. So that class is, again, tomorrow, 1:30 to 5:30. Go to the Money Show desk and register. I imagine you can just go right out here and ask. They'll tell you where to go. I know there's a small charge. Honestly, I don't even know what it is, but it's a couple $100, I think, maybe, something like that. It'll be well worth your time if you're here for that reason, to bring your trading forward. It's going to be great. Also, one other thing before we leave. Some of you guys, that we've talked to, I know you struggle with how to find the time to get the skills you need to be more successful. Where do I find the time? Like here, you got time carved out. You're in another city, most of you. You've got dedicated time. But when you go back home, there's distractions, there's work, there's that kind of thing. Some people feel like they're so close to success, but they just don't have it yet. Some people are brand new. You want to start out on the right foot. And some people just want an easier way. So one other thing that we've decided to do here at the Expo is to give some free 30-minute one-on-one strategy sessions. This is designed to help you figure out how to get to the next level. All right? It's no pressure or anything. Basically, we're going to talk to you. We're going to see what obstacles you have in your trading and give you a roadmap to overcoming those obstacles. It's free. We've got 20 sessions. They're a half hour long. I literally mapped out what our schedule is, when we can do it. John in the back of the room, John, stand up for a second. He's got a white shirt on, glasses, handsome gentleman. Please see John. He'll be standing right there in the back, or stop by our booth. But we'd love to invite you to join us for one of those strategy sessions. Thank you for attending my class, and let's do this.